What's up, everybody? Welcome back to Investing Sucks. And today I'm going to be doing a different style of video. This is kind of going to be a live analysis of an investment thesis that was posted here on Value Investors Club. And this is going to be a more casual style of video. And I'm thinking of maybe turning this into a series where I look at investment theses that get posted on this website, Value Investors Club, because I think it would be good for me to showcase more live analysis rather than what I typically do, which is very prepared and very planned out types of videos, because I think it'd be cool to see maybe my thought process as I go through these things. And I do use Value Investors Club specifically to get a better understanding of what types of companies people are looking at, and then also how people select companies, and even companies for myself if there's something I might want to look further into. And when I say my thought process, I don't necessarily mean that my thought process is amazing and any thought that enters my mind is pure gold. And you guys are all lucky to have the privilege of listening to me present my thoughts on YouTube. That's not what I'm saying at all. And again, I don't want, me being on YouTube and on this channel for me to come across as like I'm trying to be some sort of investment guru, because that's absolutely not the case. I'm like a lot of you guys really just trying to figure all this stuff out and have an interest in this stuff. But for those who don't know Value Investors Club, it is a online investment club. It was actually started by Joel Greenblatt many years ago. I think maybe 15, 20 years ago. And it's pretty interesting, because basically the way that they screen, anyone can join, first of all. You basically just have to present them some sort of investment idea. It'll be reviewed by, I guess, their team. And you can get accepted based on only the quality of your analysis and nothing like who you know, who your dad is, how much money you have, nothing like that. It's just based on the quality of your analysis. So you're getting good investment ideas, and the members have to stay active. You have to post at least 2 new investment ideas a year. I think that's the rule. And twice a month, they select the 2 best ideas, or the 2 best each month, and the winners win $5,000. So if you are interested, maybe you would want to look into joining this. I'm not sure how strict it is or how difficult it is to get accepted into it. It is pretty popular, so I'd imagine it's not easy. But anyways, getting back to the point of this video, what I wanted to do was look at an entry of a company that was posted on this website. And I already picked it out. I didn't read the entire description here, so we'll go through this. And what I like about them is they're super short, right? They're not pages and pages of super detailed things. It's really just straight to the point. What's your thesis? Talk about the company first, then say what's your thesis, and then touch on a few things like the valuation and anything else that you think is important. So I kind of want to just read this investment thesis and then give my comments on whether or not I think this is a good investment thesis, whether I think that person's done a good job, and if it's a company I would personally be interested in looking into. And also just comment on the company itself a little bit. And again, I'm not trying to come across as like superior in this sense, because I'm sure a lot of the people who post on this website are very educated when it comes to investing. But like I said, I want to do more of a live type of analysis. So without further ado, let's get into it. So the company I'm looking at, and like I said, I haven't read all of this, I've read the company overview part, is a company called Vital Farms. And if we read the company overview, you can see they're a small cap company. So I believe about 400 and 500 million in market cap. And they source eggs from family farms, over 300 such farms today, processes them at their centralized facility, and sells them to more than 21,000 retail locations across the country. So the first sentence, what I'm thinking is, okay, this is a pretty simple company, right? This isn't going to be a 10 to $100 billion company that has all these different businesses that if you're trying to assign an accurate value to, you'd have to value all those businesses individually. You can tell pretty easily that this is a simple company. And I think as retail investors, it's good to look at these types of companies. Obviously, you want to be diversified, look at a broad range of companies, but companies like this that you don't necessarily have to be an expert in the egg industry or the farming industry, because you can read about the company and you can get a pretty good idea of what the company does, how they make money, how they could lose money, and so forth. So these are the types of companies that I personally like to look at, is companies that are just simple to understand. And there are smaller companies that maybe are very very based in technology. And what I mean by that is a lot of what they do and how they make money depends on the technology that they produce. And really the only way you're going to be able to come up with an accurate investment thesis for the company is if you actually understand the technology. And understanding technology is very difficult. I think a lot of, especially retail investors, they make the mistake of thinking that they can just get a general understanding of a certain technology, and then that's good enough to understand the company and therefore invest in it and make an accurate prediction of what its future is going to look like. From my personal experience, when you're trying to learn about technology, it is quite difficult. There's a lot of layers to it. So I think it's important to just focus on what's simple, right? You have to understand what your limitations are as an investor. Don't be investing in things you understand, and be honest with yourself if you actually understand the company. So the company positions itself as a more ethical alternative to factory farms. To be certain, this is a niche product. Eggs can cost about $8 per dozen. One, I believe, can grow much larger than the current $400 million market cap suggests. They operate with a single large processing facility dubbed Egg Central Station, owned with a single nearby warehouse, which is leased. The company already enjoys strong distribution chains like Whole Foods and Sprouts, but has under 5% penetration across the broad mass market grocery category. So from that, he's probably going to say part of his investment thesis is going to be, well, for one, he probably likes that he or she probably likes that the company is ethical. And if I pull up Tickernomics here, which I have a link to this website in the description for those who don't know, this is an investing platform that I created myself, and it's currently free to use. So, and if you look at the description here, it is a certified B corporation. So B corporation is kind of it's an ESG type of term. There is a not-for-profit organization out there that can certify companies as B corporations, where they go through a set of tests to determine if they meet certain ESG requirements. So I know people have different opinions about ESG investing. Some people like it. Some people probably think it's, just really branding and marketing and isn't actually anything of real significance. And your focus in investing should be on actual cash flows. And if a company is spending money to be ESG compliant, if that doesn't actually help the value of the company, then it's probably a waste of money and you should avoid those companies. That's one take people have. I'm personally pretty neutral on ESG investing. I don't spend a whole lot of time thinking about it, but clearly this company, they are trying to brand themselves as ethical. All right, so let's get into the actual thesis now. So applying a long-term horizon and looking at the current economic and social environment, I believe VITL has several attractive investment attributes. So positioning within an affluent customer base, so affluent meaning rich. So one thing he's looking at is saying they're selling to more upscale customers perhaps, which makes sense because they're in distribution chains like Whole Foods, so that pretty much aligns, which would be more resistant to inflation and recession. So they're thinking about inflation, which I think does make sense. If there is a recession, it's going to affect a lot of companies. Pretty much any company that is selling to individuals is going to be impacted by a recession, and customers with poorer financial health, if that does end up happening. Because right now, if you look at all the signs, like, for example, banks released a lot of their earnings in the past few days, and most of the banks were saying they weren't really factoring in a recession, or at least not anymore this quarter compared to the previous quarter, and jobs are still plentiful. That most of the banks believe that the customers are still strong. And overall, it seemed like they were happy about their credit quality. And banks are good to look at for that sort of thing because they really have, their fingers on the pulse of the economy overall. So based on what I saw there, it didn't really seem like they were too concerned about a recession, but of course, who knows what will actually happen. So position correctly for social and macro trends. This one I don't like as much because social trends are hard to predict. You're predicting human behavior, which is difficult to do. Pricing power and potential for margin expansion upon eventual reversion of inflated input costs. So that's part of his or her thesis, is he's saying the input costs are higher and there's pricing, they have pricing power for whatever reason. I'm not sure exactly why, but for whatever reason, he's saying they have pricing power. The purchaser of $8 eggs is less concerned with inflationary price increases, even at the higher levels of food inflation we've recently seen. Of course, there will be some limit where even the company's core customers might balk at prices, and many already consider outrageous. But again, I generally prefer investing in luxury and lifestyle products in this environment. Eggs are also a good source of protein and calories and are still priced cheaply relative to other sources of protein, so on and so forth. So that's a pretty interesting take. That's not really, I mean, he's talking more about the business level rather than, I guess, the financials of the company, saying this is a trend that I personally have seen. I mean, it seems like anecdotal evidence to me, so I wouldn't assign much weight to that. I believe more consumers will shift to non-factory farmed eggs over time. Okay, so now we're getting into his thesis. These are non-factory farmed eggs, and again, they're trying to predict a future trend, which I think is pretty risky, right? I mean, maybe the company's value is so good that even despite that, he still thinks it's a good investment. But if you're investing based off of a trend that you think is going to happen, then you are taking quite a lot of risk, in my opinion. So many consumers already purchase eggs from neighborhood sources. VITL's Family Farms. I think I'm going to skip most of this part. It seems like they're just talking about. I'll read this part here. Actually, this is an attractive company from an ESG perspective. The taste difference of a pasture-raised egg versus regular eggs is also easily observable within this category. Their data shows pasture-raised eggs penetration going from 2% to 4% over the past few years. As an investor, it's important to share the view this figure has sufficient room to grow from here. Survey results support both A and B. Okay, so he's giving some actual data to support the thesis there, which is good. And then they're facing high levels of inflation across certain of their inputs. I'm not an expert on the whole process, but I guess here are certain inputs that are required for their process. These are at multi-year highs. The company has already increased prices mid-single digits this year and is implementing a mid-teens price increase this month with the goal of price offsetting cost inputs. Okay, so I guess they're increasing prices. That was what he's mentioning before about the margin expansion. However, beyond 2022, I expect the retail price increases to be stickier and persist longer than the commodity input inflation, which will mean revert. This dynamic will benefit from many other companies as well, but relies on one's opinion of pricing power and commodity prices over time. Okay, let's get into the valuation now. So we saw it when we looked at the stock chart pretty briefly here. This company's gone down quite a lot. So you can zoom in here. Pretty much the history we have is this just keeps going down. And they have negative free cash flow yield. It looks like they have earnings because they do have a PE. Pretty low price to sales ratio though there. Well, their operating margin is actually negative, so I'm not sure why there's the PE there. If we take a look at financials, go to the income statement. So, okay, revenue has been increasing pretty significantly. Cost of goods sold. So they have a gross profit margin kind of in the 30s, 35 range. So I guess it's gone down because of the inflation that was mentioned in the article. So that's a pretty low profit margin. So this is a pretty low profit company, I would say. And then actual consolidated net income, only $3 million, but it is a smaller company. So this is what you kind of get with smaller companies. With larger companies, say companies that are in the range of 10 billion to 100 billion, and a few that come to mind are companies like Applied Materials, Cardinal Health, Lam Research, whatever, just naming random companies. These companies are pretty big, 100 billion plus, I think some of them are. With companies like that, you don't really have to worry about the management of the company. If they're that size, I think generally speaking, you're going to be okay with the management and you're going to assume that they're competent. But there are a lot of companies out there, specifically smaller companies like this, where you don't really know who the management is. You don't even know why they went public to begin with, because personally, it seems a little strange that a company like this would be public. My assumption of it would be that because they are trying to be very environmentally friendly, maybe they think that some ESG funds will buy their stock for that purpose, and it could make it easier to raise financing in the future if they want to expand their business, which isn't necessarily a bad thing. That could be a good thing if that is actually what the company plans to do, if they can actually execute on it well. But personally, as an investment thesis, it's not that strong. And with a company like this, I would say you'd want to look into the management and actually understand who they are, because there's a lot of companies that are publicly listed that are small like this. And if you don't actually look into the management, then your investment might not work out so well. Of course, that's not always the case, and I'm not saying that is the case here, but it's a risk you have to understand when you're investing in smaller cap companies, which if you want to look at companies where there's more likely to be a price to value discrepancy, you do kind of got to dig through the garbage bin a little bit, if you know what I mean. You got to find companies that not a lot of people are tracking, not a lot of analysts follow them, and maybe they have stock prices that look like this, where the average person looks at it and says, okay, no thanks, just because it looks like it's going down, right? Because if you're a value investor, you believe price and value over the long run are generally going to be equal to each other, and a price at some point will catch up to value, whether that could take 3 years, 5 years, 10 years, whatever. So your goal really is to just focus on value. What's the actual value of the company? So let's look into the valuation one. Has been reduced to one-time sales. The company already features a 30% plus gross margin despite recent declines. So that's what we saw. Revenue is forecasted to grow 30% to 20% to more than 415 million. The current facility recently completed an expansion, so that's good, and is capable of supporting 650 million in revenue. That's a really good insight. I like that because they're showing they've actually done some real due diligence and they know what the company's capacity is. So then they can say, if the company is able to increase in demand and all these trends play out like they're saying they are, the company actually has the capacity, because they do manufacture things, right? It's not software, that it's just infinite scalability. They do manufacture stuff. So you need to know that. So I like that. Management has plans for an additional facility. So maybe they would raise equity financing. That's probably why they're a public company, because they want to be able to expand a bit easier. My own assumption suggests that the company's ambition for low double-digit EBITDA margins in the long term is understated and easily achievable. So then he's kind of going against what management says, which to me sounds like an assumption. And I think with this year, I mean, maybe they excluded details just because they wanted to be concise. But if you're going to make a statement like that, like I think EBITDA is going to reach this rate, and what management has stated is they've understated it and it's easily achievable. You have to add some weight to that. You have to explain why. Maybe they have a reason, they just didn't explain it here. In the context of this revenue and margin potential, the current enterprise value of 350 million is an attractive entry point for me. So if enterprise value is 315 million, and the market cap they said was 400 million, that probably means they have quite a bit of cash, because cash would reduce enterprise value. Yeah, so they had investments in cash, looks like 31 million cash and cash equivalents, 69 million in short-term investments. So that makes sense. And they probably have a low amount of debt as well. Yeah, as you can see, pretty low debt overall. Yeah. All right, but that pretty much concludes it. And then goes on to mention the company's certified B Corp, its overall conscious capitalism, brand positioning. So back into the whole brand thing. So overall, I think this investment thesis has some good things, but it has some bad things. I don't really like how they are relying on one trend specifically. For example, what they said about this company, what basically saying here, the whole pasture raised eggs versus regular eggs. And, just because it's a trend that's developing doesn't necessarily mean it's going to continue into the future. And maybe if inflation does stay high for an extended period of time, that trend could face some pushback and it might not actually happen. Again, I don't really know, but those are the types of questions I'd want to ask. But there were some things that I liked. They do have an actual, there were some things, for example, that I wish they would have provided more explanation to, because if you're going to make a statement like that, you need an explanation to it. But the fact that they're pointing out things like pricing power, margin expansion, the fact that it's probably undervalued now because their margins have been compressed as they've gone through some tough times due to inflation of input costs, that shows that they're actually looking at this business because maybe it's hurt from what's going on in the economy overall. And if things normalize, then it could get back to normal, which I think for smaller companies like that, that's a pretty good source of finding mispricings and finding good value investments. Because sometimes if the company reports a few bad results, it could be written off by some investors out there. And because it's such a small company that probably not a lot of people follow, they may not be looking into it as much. So anyways, guys, that's pretty much my thoughts on this. Let me know what you think of this type of video where I kind of just film it in one take and give you just my reactions off the cuff and don't plan things in advance. If you like it, then please like the video and let me know what you thought of it. And if you're new and you like this type of content, then please consider subscribing. And I'll see you guys in the next video.